So the data quality is. Oh, okay. We're being recorded, I learned. So, and what do we find? Well, there are three main insights that we are taking from our work. And they're important for financial investments. They might also be important for real investments if you think about that. So our key finding is that the attractiveness of these dividend strips depends on the holding period. Yeah? If you're just measuring everything on monthly holding periods, so you're observing the prices every month, and then based on that, you're computing your returns, they have much lower performance, much worse performance, in particular because they're really, really noisy. If you're holding them for longer periods, so you're measuring your returns over a year or even over 5 years, then you're kind of wringing out a lot of the volatility in these securities, in these returns. And because of that, the Sharpe ratio improves markedly. And I will demonstrate very slowly how this is actually working and where this is coming from. This has to do with noise in the data. And once we deal with that noise, we're getting this improvement in the Sharpe ratio. So the high Sharpe ratios of these dividend strips, if you're holding them for longer periods, they actually constitute what we call this attractiveness of the dividend strip. And that's an important new item that we are contributing here. We also find that dividend strip returns vary much less than market returns over the business cycle. After all, the business cycle is really using the market return in order to grade periods into when the market is going up and when the market is going down. If we're looking at the dividend strip return during those expansions or during those recessions, it moves much less dramatic than the market. In particular, during recessions, it doesn't even turn negative, but it stays positive. It's lower during the recession than it is during the expansion, but not nearly as low as the market. So it actually serves in our mind as a recession hedge if you're turning to these dividend strips. That's our second finding. Our third finding is that the equity term structure slope is highly predictable. Okay? So first, the equity term structure slope, that would be the expected return on the market minus the expected return on the strip. So the difference between the two. And that difference is highly predictable, in particular at longer holding periods, also at shorter holding periods, but in particular at longer holding periods, by the relative prices of long and short duration equity. Yeah? So if you're taking the relative prices, you're having a very nice predictor. You can also view these relative prices as relative dividend price ratios. Right? Good. So at this stage, we are having kind of an outlook of what this paper is about. And now let me go into the mechanics of what we are doing here and how we actually obtain these dividend strip prices. We use SPX options, same as in the original BBK study. And our data sample is now a much longer 1996 through December 2020. Mind you, BBK ended in 2009 and was published some 3 years later. So we're adding a substantial amount of data here. Other than that, we use the same filters as BBK because they sounded rather sound. We're observing everything on the last business day of the month between 10 o'clock and 1400 hours. We're using midpoints as they did. We filter out that prices are somewhat substantial, so they need to be larger than $3, and weed out very, very low priced options. We are pretty generous on the moneyness and go all the way from 0.5 to 1.5, so essentially including everything and hardly excluding anything. And there is a robustness detailing that these assumptions and filters do not really matter that much, but I'll turn to that later. We also go for options of more than 90 days to maturity. In order to work out the dividend strip prices, so we are not at the return stage yet. Right now, we want to get the prices of these securities, and then we take differences in order to get to the returns on these securities. We take the prices of these dividends from put-call parity. So we are rewriting put-call parity in such a way that on the left-hand side, we are having here the present value of the dividend claim on this particular set of options. And that is equal to the stock price plus the put with some kind of maturity minus a call with some kind of maturity at the same strike minus the strike discounted over the time from now until maturity. This maturity we can vary, and we're typically going for the 1.9 year strip because we're having good data out to this 1.9 year period. And we are buying set securities. So this would be, we are buying the securities that gives us a claim to the next 1.9 years of dividends. Let me go to the last point on this slide first, and then I cover this third point on the use of interest rates. To round out the strategy, to compute the return, we buy the 1.9 year strip. We hold it for half a year until it, as maturity is now shortening, until it becomes a 1.4 year strip. All the dividends that are being collected while we are holding the security, they accrue to us over time. We reinvest them into the same strip, into the same security. And finally, we sell after that half a year. So at the 1.4 year point, we are selling the security that constitutes one return over this half a year. And we repurchase a new security that again has a 1.9 year horizon. Okay? So we are rolling over set strategy over and over. It's always, it runs for half a year, and then we're investing into a fresh 1.9 year strip. We're holding that. So this is a rolling claim, collecting these dividends over and over again. And the maturity is always varying, okay? As we are getting shorter and shorter to 1.4 years, and then we're moving back out to 1.9 year. Now, I'm returning to this issue here on the correct interest rate to use. In put-call parity, there is simply here the exponent of e to the minus RF. So it says use the risk-free rate. And many people use the option metrics supplied interest rates. And those are zero curve rates. Yeah? What we find is that these zero curve rates are not the interest rates that the market is actually using. Yeah? The market is using an implied interest rate, which is 4 basis points smaller, which could easily lead one to believe that, well, 4 basis points, it shouldn't matter that very much. But indeed it does. What happens is the 4 basis points might be small, but the elasticity of errors in the returns on the strip introduced by some kind of small error in the interest rate, that is actually a rather large minus 5.49. So what happens is, even if you're only having a small interest rate error, it magnifies by this factor of minus 5.5 into a sizable return downward. If this is smaller and you multiply it by a negative number, then that actually inflates the return. Okay? So the dividend strip returns are inflated if you're using an interest rate that is too high, and if the true interest rate is actually lower. Now, what is the true interest rate? Ben has some older work on that. And from put call parity, we can actually find out not only the dividend that the market assumes to receive and the present value of that dividend, but if we are using two pairs of put call parity puts and calls, then we can solve for two variables. So we can solve for the dividend price, the present value of the dividend, and we can also solve for the implied interest rate, that interest rate that these option traders are actually using, as opposed to the exogenous zero rate. We split our sample in two parts. In the older sample, 96 to 2003, we actually use this particular technique where indeed we're going for two put call parity pairs to cancel out the dividends and to get the risk-free rate. Okay? And we're doing this minute by minute for all the pairs available, and it's essentially an outer product of the available pair. So you're combining every available pair with every other available pair to get two pairs. From that, you cancel the dividend, you get a risk-free rate estimate. You do that for the whole day, you get many of those, and you take the median essentially. That is our market implied interest rate, and we're strongly advocating that this is a good method, and this is that using these implied interest rates is actually improving results. Now, in the latter part of the sample, 2004 to 2020, observations get so numerous that doing the outer product approach minute by minute within the day simply becomes too time consuming and too tedious. There are so many within minute put call parity pairs that if you're combining everything with everything, it just gets out of hand. What one can do, and we checked around 2004 that the two approaches do not give any different results, you can simply use a regression approach. Essentially, you're using the put call parity as I have it here on the slide, and you're turning it into a regression where you're estimating the whole discount factor here and the dividend over here. That gives you for one day then the correct implied interest rate and also the price of the dividend strip. Good. At this stage, we have the strip prices, we have a strategy for rolling them over, and we are ready to investigate them a little bit. Now, what do we find? Well, first we find that the strip return at 7 and a little percent is somewhat smaller than the market return at 9%. Once you correct for the risk-free rate, and the strip we match with a 2-year bond, because the strip has about a maturity of 2 years, and for the market we are subtracting the 10-year bond. So as the term structure of bond returns is typically increasing, you're subtracting less here and you're subtracting more over here. So once you correct for the risk-free rate, and you're working with these risk premia, the result becomes even smaller. Here the strip premium is actually slightly larger than the market premium. Now, the second observation is that even though returns are broadly the same, so we're kind of in between BBK saying that the strip is much better, and Bansal and colleagues saying that the market is much better. But what we note is that the standard deviation on the strip is just massive, more than 30%, whereas the market standard deviation is more like 15, 18%.
Can I jump in with a question here?
Yep.
So we have a question from Steve Figluski.
Yeah,
so
sure.
Why is it important to use intraday data to estimate the interest rate and dividend yield that we don't expect to show much variability during the day unless there's a lot of noise? How much variability is there within a day?
There is actually quite a bit. So these put-call parity relations, because you're using midpoint option prices, and the option prices move in these discrete changes, the put-call parity relations do not work out perfectly. So you're getting risk-free rates from every pairing, but they hop around like bunny rabbits throughout the day. So you got to calm them down. And you want to have many of them. You want to have a lot of them, as many as you can. That is why we also take medians, okay, to just stabilize that, because some of these put-call parity implied interest rates, they can just be off the wall. So to really trust our results, we want to use as many as we can. And that is why we are using all the put-call parity pairs throughout the day that we can track down and then work out many local observations of the risk-free rate, and we combine them into one daily estimate. There is a very slight timing issue here, because we are then taking the median across risk-free rates, which are computed at the start of the market and at the end of the market, and there is some 6 hours in between. But with a 2-year horizon, those 6 hours shouldn't really matter that much. Right? So we feel safe that we can take the median at that level. But there is noise. There is actually lots of noise, and you really need to calm that down. Okay?
So then, can I ask a question? So you,
Sure.
in doing this, you have the cash S&P index at 1 minute frequency?
Well, we get the record. What do you mean with cash index?
So,
this is the S&P record that you can buy. Yeah, that is the current value of
that you have the current value of the index at 1 minute frequency.
We're actually having that tick by tick.
Tick by tick. Okay.
So that's even finer, and then we are pulling it to the minute where we need it. Okay. So that we have at a very fine time step. Yeah. So the Sharpe ratios on the strip are actually somewhat lower than the market, but mind you, this is all at the monthly frequency right now. So we're measuring this with very short holding periods, and we're checking our results every month. And the whole point is that, well, maybe it's a better idea of holding it for a little bit longer. The big hint on this is coming here from the minus 0.34 autoregressive component in these strip returns. So there is a lot of mean reversion, and that is what we are after, and we are arguing. So Ben, at this stage, set up a very straightforward model of measurement error, so simple that even I can follow through it. So there is a price based on yesterday's price and some kind of innovation. That's a true price. And then you're having the price measured with some kind of error, and that is what you observe. Now, sticking everything back together, the measured price then has to do with yesterday's measured price, with the innovation to the true price, but it also has to do with this difference in measurement errors. So we're having a very straightforward little model of prices, including measurement error. And what we can then work out in this simple model is that the variance of the true returns is equal to the variance of the observed returns times this adjustment factor 1 plus 2 times the AR1 coefficient. Plug everything in, and it works out that the true variance needs to be 19% squared, and that is then equal to 33% squared. This is what we observe in the market. This is the volatility of the strip returns, 33%, times 1 plus 2 times minus 0.34. This is our measured AR1 coefficient from the data. Yeah. The whole right-hand side we observe, and we back out the left-hand side. And this now looks much nicer. Right? This is much more in line with how volatile the market is. The market, the claim to the long-term dividend, had a volatility of between 16 and 19%. And here we're also having something like 19% for the dividends.
Does the measurement error also bias the estimate of the average return?
No, we're doing this in log returns. So this is no longer affected by that. Okay? If you're doing this with straight returns, then you have that as an additional issue. That is why we moved. Sorry, I should have explained this more careful. You see on the slide, I'm already talking about log prices. Okay? I want the log prices to have log returns. I want the log returns so that I do not have this contamination by plus 1/2 the variance in my returns. This is exactly why we're doing that. So thank you for pointing that out. Now, if we are having this measurement error, then holding returns for only one period picks up on much of that measurement error. Holding returns for more periods cancels that out to some extent, because you're only observing the price not every month, but say only every year. And this is exactly what we're getting over here. Here I'm showing you for different holding periods. So starting out at 1 month, this is what we had in the earlier table. The annualized volatility sky high at 33% for the dividend strip. For the market, it was something like 18–19%. And then as you're now measuring these holding periods for more and more months, the dividend strip volatility is markedly coming down. And this is exactly the smoothing effect that you're getting by kind of sitting out the AR1. The AR1 makes these prices move up and down in a very particular way. You're having a high return, it's more likely to be followed by a low return because of the negative AR1. You wait for more periods at a time, everything calms down considerably. It calms down actually to a level where volatility is much lower than it is for the market. Now, let's put together our findings so far. Returns on these two securities are broadly in line. The one was 8% a year, the other one was 9% a year. They're broadly the same. Volatility is coming strongly down for the dividend strip and stays about level for the market. Divide the two into each other to get the Sharpe ratio, you're getting this picture. The Sharpe ratio for the market is not much affected. There is actually a very slight positive autocorrelation, which is giving you this slight decrease here. The Sharpe ratio for the dividend strip is going through the roof. It's really strongly moving upward. Why? Because here at the far end, where you're holding for many periods, you're suppressing volatility in your measurement, and your Sharpe ratio then markedly improves. It is not that the return is improving, it's that you're doing away with the volatility that you're suffering if you're trading in and out of these securities every month. Holding them for longer periods, you suppress that. Okay. I next want to turn briefly to the business cycle, highlight some results concerning the business cycle, and then get to the predictability results. First, I'm looking at realized returns here. And the realized returns are such that in an expansion, well, most periods are expansions, there are not many recessions. The strip is returning 8%, the market is returning 12%. So everything is happy in the expansion. During a recession, the market is losing heavily, minus 23%. This is, after all, how we define a recession. But the strip return is not that bad. It's still 4%. But then, mind you, it has a huge standard deviation. So it is very, very volatile. This is all measured at the monthly holding period. So we are getting the full exposure to the high volatility of the strip returns. And during recessions, strip returns are even more volatile. They're here having a whopping 50% volatility. So yes, the mean estimate is positive, but the point estimate is positive, but we wouldn't be able to test for that and claim that this is positive in a statistical sense. People then thought about, well, realizations during the expansion or recession is one thing, but what about expected returns? And to measure that, the literature has argued that maybe not look at the present return, but look at the return that is realized over the following year into the future from the particular point in time. Okay, so let's use that as an expectation, assuming that the investor was actually capable of making up their mind as to what kind of return do I expect over the next year. And we proxy for that by observing. Now, as researchers, we can do that. We go forward in time and look at the historical data. We see what happens during the next 12 months. We take the average of that and we record that as the expected return. That gives a fairly similar picture if we use NBER recessions here in red and NBER expansions up here. If you compare these values for the short duration asset and here for the market during the expansion, the values are fairly similar to the realized return scenario. There is an alternative way of defining good times and bad times. So good times being expansions, bad times being recessions. And Gormson argued in a paper that, well, maybe one should look at low market dividend to price ratios. And they would give an indication. If they are low, then the market expects that better times, that we are in an expansion time, that we are in a good time. If they are very high, then we're in a recession. Now, defining good and bad times according to this Gormson market dividend price ratio, unfortunately flips results upside down. And conditioning, again, using this Gormson idea on the strip dividend price ratio, flips results yet again, and they're kind of back to where they were when you're conditioning on recessions. So this is weird, right, to say the least. The term structure of dividend assets So the difference in expected return on the market minus the expected return on the strip, it's pro-cyclical when you define everything based on NBER recessions. It's counter-cyclical when you base it on market dividend price ratios, and it's pro-cyclical when you base it on strip dividend price ratios. So this cautions that one should not really use these asset-based measures, as they do not seem to correlate much with the business cycle. So the market DP ratio and also the strip DP ratios, they simply do not have that much to do with recessions and expansions as we define them according to NBER. So maybe this is not the greatest idea of using them to define good and bad times. In that case, why am I actually presenting this? Well, we still learn something from this particular flipping of the expected term structure. And this lower part down here, this is what I'm after. The difference between expected market return and expected strip return, so this term structure, that ought to be predictable by the relative prices of the strip and the market, or by the relative values of the dividend to price ratios. Yeah? That is why I need these Gormson results. The Gormson results say that if you sort everything based on the strip DP ratios, you're getting the term structure sloping one way. You sort it on market DP ratios, it flips the other way. But if this is the case, then the ratio of market DP and strip DP got to tell you what is happening. If the term structures switch according to these DP ratios, then dividing one ratio by the other need to give you some information about what is happening to these term structures. There ought to be predictability, and this is what we are after. The next model is trying to do exactly that. We are having a present value model with an AR1 component for the dividend growth process. The dividend growth is autoregressive and has some kind of error. The expected market return has its own dynamics and is also allowed to recur on its lagged values. The strip return is simply the strip return. One can then use the Campbell-Schiller 1988 decomposition and work out the two log dividend price ratios, the log market dividend price ratio, and down here, the log strip dividend price ratio. And I don't want to go into the detail and the exact coefficients here, but I want to highlight what are the moving parts in all this. The dividend price ratio for the market involves a constant. It involves the mean market return and some kind of multiplier. And it involves, as a negative term, another multiplier and the growth rate. So market returns help, and the growth rate is actually detrimental. It moves the DP ratio down. You get the same mechanics for the logarithm of the strip dividend price ratio. The mean has a positive influence. The growth rate without any further coefficient has a negative effect. Put everything together and sort so that we can look at the expected term structure. That is the expected return on the market minus the expected return on the strip. That's the term structure we are after. It has a constant part, fine. It has a part that has something to do with the DP ratio, the dividend price ratio on the market, minus the dividend price ratio on the strip. Okay, so there is a little adjustment factor down here. I will talk about that in a second. So it's a difference in DP ratios, and it has something to do with the growth rate. This is enough structure that we can actually now run a regression. And we're running a regression based on the return on the market minus the return on the strip. And we're doing that for different holding periods. We can do that for 1 month. We can do that for 1 year. We can do that for 60 months. We are trying it for all these values and see what is happening. We are estimating a constant part. This is this coefficient up here. We are using the difference in the DP ratios. We are using also the adjusted difference in the DP ratio, because the market DP ratio needs to have this adjustment factor. So we can try that one. And finally, we are also using a version where we are putting in the dividend growth. And our proxy for that is the log trailing indicated dividends. Okay? So this is survey-based and forward-looking from market participants who are giving an indication of what they think are the indicated dividends. Let me show you the results as I'm slowly winding up here. In the top model, I only use the scale differences in DP ratios. So for now, the dividend growth component I switched off. The DP ratios, I take the difference, but I scale them so that the market DP ratio has that correct multiplier. Okay? We also did a version where we skipped that multiplier, and that looks very similar to what we are having here. And what we are seeing in terms of the R square is that there is an impressive performance of our little model, in that, in particular, at the longer horizons, at the holding periods of 60 months, we're getting a 2/3 predictability of the term structure. So dividend price ratios and the difference thereof has an R square of almost 2/3 at the 5-year horizon to predict the term structure. We can soup up this regression a little bit by adding the dividend growth rate, this indicative dividend growth rate, and throwing that in as an additional factor. That ups the R square by here at the long end another 0.06. So it's not a game changer, but it's kind of nice that it works the way it's supposed to work according to our little model. Now, it's robust. And we can kick the tires, and we can change, for example, the strip maturity from 1.9 years to something shorter. So let's have it only 0.9 years, then run it for half a year and invest again into a new contract, or do this at the 1.3-year horizon, keep that for half a year, roll over. It doesn't really matter. Using other exogenous interest rates makes the problem even worse. Okay? The zero curve rates from option metrics, if you use them, it's already bad enough for the returns on the dividend strap because it inflates them. If you're using yet different interest rates, it gets even worse because those interest rates are even further away from the implied interest rates, and you're having even larger errors you're introducing into the estimation. One can lower transaction costs somewhat by holding to maturity instead of rolling over. We tried that. We can change option moneyness to a tighter interval instead of having the super wide one that includes all these options. We can do different subsamples to match, for example, the BBK paper. but the quintessence is that our results are very robust to these changes. So not much is changing at this level. Now, let me wrap up at this stage. Dividend strip prices are estimated from intradaily S&P 500 options data, as in BBK. We're using a longer time series, expanding that from 96 to 2020, so adding some 11, 12 years of data. And that allows us to work out dividend strip returns. We use the implied interest rates instead of exogenous interest rates to avoid any bias and to avoid that these strip returns are being inflated unduly. And what we show is that the dividend strip returns are much more attractive than the market returns at longer holding periods. This is important. Okay? You need the longer holding periods in order to push out the measurement error, the noise in the data, which you're getting when you're rolling over your strategy every month. Then that is rather noise-ridden and has a very strong autoregressive component. Hold that for longer periods, and it emerges that volatility comes down, Sharpe ratios improve greatly. The strip is a very nice recession hedge, and the realized equity term premium is highly predictable by the relative DP ratios and thereby by the relative prices of long and short maturity assets. Now, at this stage, I'm out, and we got a few minutes for questions if there is anything coming up.
Great. So at this point, anyone who wants to ask a question should feel free to unmute yourself and use your microphone. It's your chance to ask Jens and Ben whatever you want to. Tell them they're wrong. Okay, well, people are thinking about what questions to ask. I'll ask a sort of obvious one, right? Sure. So is it realistic to actually, for an investor to buy the dividend strip, right? Is this tradable? Yeah, it seems to me you have to trade two options plus the index to synthetically create the dividend. I mean, can an investor actually achieve these returns?
It is not the easiest strategy, but it's a deeply liquid market. One caveat is that we are using midpoint prices, right? And in the data, you're having options quoted at bid and ask spreads, or at bid prices and ask prices, and these bid ask spreads tend to be rather large. Now, because of that, implementing a trading strategy based on the records that you're finding in the data is probably not realistic and will not work. But what we learned from talking to people, talking to traders, is actually that there is apparently a huge price improvement possible. Definitely not for the likes of us, who would be retail traders being taken to the cleaners and all this. But for market participants. So sophisticated traders seem to be able to regularly get substantial price improvements, so they can trade much, much closer to the midpoint than what is quoted in the record that is commercially available for us to buy. Now, there is no consensus of how much this price improvement is. Right? It seems to be that you can get 2/3 closer to the midpoint than the bid and the ask is, but there is no real hard evidence on that. This is what the traders feel and state, and what we learned from conversations. But it's difficult to work out how well this actually works. Yeah? So this is a long-winded answer to we don't really know. It is not as possible as we computed because we're using midpoints, but it is not as bad as using the bid and ask error in the data record. Okay? It's something in between, but we don't have a clear idea of those numbers. We haven't implemented a trading strategy.
So actually, just one observation. There is a paper by Dimitri and some other guy that actually tries to estimate how much price improvement you can get. But anyway,
All
that's
right.
So Francois Kokoma apologizes for being unable to mute, but then he asks, he says, wonders, I may have missed why you were not using trade prices.
Because there are very few of them. And if you need put and call parity pairs, you need to have them close by in terms of timing. So it's fairly easy on the quote record to get a put and a call that is actually having the same strikes, the same maturity, and close enough in quoted time within the same minute that you can put it together into a pair. If you're trying to do that for trades, you're hardly having any pairs. It would be a great chance that during a day, within 1 minute, you're having a single put and a single call that actually matches in maturity and strike. Your sample just goes away. There is no way. Okay.
So I have one other kind of question or observation. So I think I heard you say that your option implied interest rates are a few basis points below the interest rates available on option metrics, which are from, well, a combination of cash LIBOR and the Eurodollar futures.
Right.
That's a little bit surprising because after the crisis, other people who have tried to estimate, intermediaries' funding costs are getting implied rates above LIBOR. So I am a little bit, puzzled as to why your option implied interest rates are below LIBOR, where I had the impression that the consensus is that after the post-crisis, intermediaries' funding costs tend to be above LIBOR.
Well, that's a good question. So LIBOR does also contain some risk components that the banks are having. Okay, so to the extent that after the financial crisis might also not be zero or completely irrelevant, one has to figure that into these numbers. My take on that would be that most of this option trading is not really held overnight. A lot of the participants in these markets cancel positions towards the end of the day. They do trades throughout the day, but then try to go flat home for the night, and or hedge these positions. And these positions are eminently hedgeable in that you're having the underlying readily available. Okay? So my take would be that possibly the funding requirements these people have are just not that incredibly large. Okay? So that they can use a fairly low interest rate.
Anyway, I'm sorry to be monopolizing the questions. I'd really like to invite anyone else who has a question to feel free to unmute yourself and shout your question out.
Question from Figlewski. Hi, yes, that was really nice. Yeah, very interesting, provocative kind of paper. Suppose we start with a pure Black-Scholes world where everything is priced, all options are priced according to the Black-Scholes model. Then we can use a procedure like yours to extract an interest rate is going to be the same across any set of pairs you'd ever have. Now, suppose we say that people will pay up for puts that they, in a way that they will not pay up for calls. So that now in the Black-Scholes world, all the calls are priced according to Black-Scholes, and all the puts are priced according to Black-Scholes, but a little bit richer. What does that, how does that affect what you're doing? It seemed to me that the implied interest rate coming out of the puts would be different based on a difference in kind of a put risk premium. And I haven't been able to think my way through this in the 2 minutes that I've been thinking about this, but I wonder if you have any thoughts on that. And before asking you to answer that, I just want to wonder if anybody knows, has anybody talked to actual market makers about what interest rates they use in their pricing? Those are my questions.
Well, first, I think the assumption of a complete Black-Scholes economy would not work with the second part about, but the puts are always priced a little bit dearer, right? For that, I would leave out the whole Black-Scholes bit and simply start with put call parity and maybe have in the back of my mind some kind of demand-based model where the put prices are simply a little bit higher. That would definitely let me think about that before I'm putting a foot in my mouth. Yeah, no, that would change the implied interest rates.
Yeah, I think Neil's question is very well taken. That it's a little surprising that the interest rate people would be using in trading options would be lower than essentially zero riskless rate that we get out of option metrics. But what you said was, okay, so apart from the Black-Scholes model, we would expect to see there's structure within across strikes in this implied interest rate. And I wonder if you've seen any of that.
Yeah, that we have not seen. Okay, so we did check for that. Ben is looking slightly surprised there that we did check that, but we did in that. I actually looked at graphs like that earlier and not part of this research, but in general, I have been looking at these implied interest rates already several times in my career. And at those instances, I plotted them across moneyness and across obvious option characteristics, and there wasn't anything systematic. So it was not that one could easily attribute that, oh, it's always on the left-hand side of the smile where we are suspecting that the put prices are kind of too high, and because of that, these interest rates are moving all over the place. It also, if the put prices are too high, also the call prices need to move, right? According to put call parity. You cannot have the two completely, or you cannot have one move without the other one moving. Then you're getting these weird interest rate effect. It is just that in terms of put call parity pairs, we are often don't observe that many pairs for, say, the deep out of the money puts, because you're often not having trading in the corresponding call, right? Because the put trading is concentrated on the left, the call trading on the right. So our pairings are happening more often around the center, right? And I'm looking. I think Ben wants to mention something on this topic. You want to jut in and. Okay, Ben, I'm handing over. You need to unmute yourself, yeah.
I just did. So, hi, I just wanted to add here that in terms of the interest rate discussion, we also have a figure in the paper, and there's actually a time series variation into how good the option implied interest rate zero curve actually captures the implied rate. So the two seem to be actually pretty close together in the BBK sample. So up to, let's say, around 2010 or something like that, the two were pretty close together. And in the recent period, we do actually observe also what Neil was pointing out, that the zero curve rate can be actually lower than the implied rate, which is kind of consistent with the manipulation of the LIBOR, which is actually also related to our other work. So, one thing is talking about the averages, whereas, there's a couple of basis points of difference, but there's also the time series variation in the difference between both of them. Thank you.
Can I ask a quick question? So sorry for missing most of the talk, but I'm wondering whether taxes play a role here somehow, right? So then you trade options, then like roughly half of your profits will be taxed at the short-term rate, while if you're buying the market, most of your profits will be presumably at the long-term rate.
No, we have to look into that. Taxation, yeah. I simply don't know.
Stock index options are treated a little bit differently. They're treated like, or options on the futures are treated differently. And they have a 60-40 treatment at all maturities.
Well, SPX options are also 60-40 because I trade those. This is why this is the main reason why people trade SPX and not SPY options is 60-40 treatment. For the transaction cost, you also, like, if you really get bugged by those comments about transaction cost, you can go to SPY options. The quoted bid-ask spreads are much narrower there, because in SPX, well, options on SPY ETF, right?
Okay.
So in SPX, you can have like quoted spreads of 10%, effective spreads of like 6%, while for SPY, they will be like, well, 2% or so.
Okay.
Of course, the reason people trade SPX and not SPY is because of the tax treatment and because the commissions are lower for trading SPX. One SPX option is about 10 SPY options. So then I trade SPX, my commissions will be like 3 times lower than my bid-ask spread that I pay. But if I trade SPY options, my commissions will be important.
Right. Okay, but that's a good point. We simply need to look into that.
The one issue with SPY options, or actually there are two issues with SPY options for our purpose, is one is the length of the time series. We're starting here in 1996. So you don't really have liquid SPY options going that far backwards, and they're also American. So the nice thing about, for our purpose here, because we're using the put call parity, is that we have the European options. But one could potentially also do at least something on the more recent sample to compare XSP options to SPX options. So basically the mini options with the large options, to see whether people want to preferably jump into smaller ones and trade into those a little bit more.
No, those options are for suckers. The mini options. I mean, my point about SPY, if people tell you like, well, SPX spread is just this big, you tell them, look, but people can trade SPY where it's like 5 times lower spreads.
Right.
So let me suggest a sanity check on these estimates of the implied dividends, right? For the very last part of your sample period, there are dividend futures contracts available, right? So it might be worth checking whether your implied dividends are consistent with the prices of the dividend futures.
Yeah, I can take this one. So the issue is getting the dividend futures data now. So it used to be that Goldman Sachs shared this data. So for example, what also Jules and Ralph actually used, but they no longer do that. So
but doesn't the CME sell it?
Oh, just the exchange traded ones for the last 2 years.
That's what I say, only the last few years.
Okay, yeah, for just the last
so
few
it could
years,
be a sanity check for the last few years, yeah.
Okay. There is actually a little bit of the trick there that it's not the same index. because it's the dividend index that is constructed slightly differently. So it's not really the dividends on the S&P 500, but it's the dividend index constructed in a similar way, but not exactly the same way.
Oh, okay.
There's a little bit of a caveat there. So it's not actually also directly comparison. I mean, it's approximately comparable, but not directly comparable.
But I still might be useful for sanity check on the results.
Yeah, that sounds very reasonable.
Yeah, that I agree. Yeah.
Well, possibly using ES futures would be an idea too, right? I mean, conceptually, at the money, what you're doing is essentially buying the spot, taking a short position in the futures to hedge, and borrowing the cash to buy the spot, right? So essentially, you can just do that with the ES futures and see if it gives. It boils down to using only at-the-money options, right?
Well, so it's a related point. This is almost has a lot of overlap with Christian's point, is that the futures have low bid-ask spread, and they should pin down the difference between the interest rate and the dividend yield. They don't pin down the interest rate and they don't pin down the dividend yield, but it seems like there's useful information because they pin down the difference.
So in actually in one of my previous papers, I combined options and futures to pin down both of them.
Okay.
So that's actually an alternative way of doing it. So here we're just using options to pin down both of them, but options across different maturities so that we get the identification. And in that RFS paper some years ago, I used the futures and options to pin down both of them together. And we think it's important to actually pin down both of them simultaneously. But if you do the options and futures, then the advantage is that you can actually use daily data, kind of because they both expire at the same time at the end of the day. But the issue is that you only have quarterly frequency because futures only expire every quarter. So there are pluses and minuses there. And in terms of calming down the estimates, so this is actually goes back to Steven's comment on the managing pricing noise. It seems it's a little bit easier to do it in the options market because you really have in the intraday data you have just so many different pairs and you can just take the median across those. It's much easier. Whereas if you just use the daily data and then the options and futures, you kind of have to do some type of smoothing over the past, let's say 10 days, past 15 days or something like that to actually achieve something similar. So here it's actually much better if you can use the intraday data and then just the options. So at least this is what we do.
And of course, we're getting 3 times more data points. So our regression is always on 300 data points. If you're going to quarterly, you're down to 100, and then econometrically, things are getting ugly. Huh?
Very good point. Someone else wants to jump in for a last quick question? Otherwise, on that note, we thank you very much, Jens. It was, as Steve said, very thought-provoking, and clearly the discussion that ensued highlighted that. So thank you again for your time. Thank you for this great presentation, and I hope we'll see you again in 2 weeks when Olivier Daviau is going to join us and present a paper on linking the performance of vanilla options to the volatility premium. So it's going to be a bit of a practitioner's perspective on a question that really does matter to all of us. So we're looking very much forward to having Olivier in 2 weeks. On that note, thank you very much for having been here today.
Perfect. Thank you. Goodbye.
Thank you.